Hey everybody, thanks for joining tonight. Tonight I've got a special guest, one of my partners, Michael Bencks with Guaranteed Rate. And tonight we're going to cover the home buying process from start to finish. So from the pre-approval through the search, and then everything that you need to know from when you write a contract to when you close. So with that, I'm going to turn over to Mike. We're going to cover, he's going to cover the pre-approval process a little bit and what to look out for.
Hey, what's going on, everybody? Michael Bencks here. We really appreciate everyone in attendance. Taking time out of your night here to join us for some home buying kind of tips and tricks or whatnot. As far as the mortgage process is concerned, a lot of realtors want their clients to get the financing lined up before they start viewing properties, right? Tom, you don't want to take someone out and show them, properties that are $400,000 or $500,000 when maybe their price point or payment goals are more suited for like a $300,000 place, right? That saves you saves your time and also manages expectations for the buyers. So with all residential financing, I typically break it down. It's three main pillars, very straightforward. It's credit, income, and assets, right? So credit scores obviously on your credit reports, based on payment histories, credit card balances, late payments that might have occurred, etc. So once we get your scores, we kind of know where that will lead to what interest rates you get. Income, job, and are you salaried? Are you self-employed? Are you 1099? Do you maybe have a bonus or commission structure in there too? So we always want to verify and make sure that the money, the income coming in is easy to document. And then the last part is assets. That's mainly just your down payment funds. If you have money in the bank, if you have money in a 401k where people often will borrow money from that for a home purchase, you might be getting a gift from a family member, from a parent or something. So we want to make sure that if you need a certain amount of money for the down payment, and the closing costs and all that we have a plan of attack to get to that number. So once we do that, pretty straightforward as far as issuing a pre-approval, credit, income, and assets.
I got a question for you. So a lot of people have this 20% number in their head as far as down payment. What's the reality as far as like how much money do people need to put down? How much do you normally see your clients?
Yeah, very good question, very common question. So historically, 20% down is always the benchmark for down payments. And anything less than a 20% down payment, unless you're a veteran, and then it's a couple other niche loans, but basically anything less than a 20% down payment has something called PMI in the equation, right? So private mortgage insurance, PMI are all synonyms. And when that came about many, many years ago, and this is going to show how old I am, but when that very first came about way back when, it was so expensive. So not only did you have people that maybe had 10%, so they had 10% to put down, their interest rate was higher, and then they're paying this PMI monthly. That was super expensive, that they couldn't buy a house. So that there was almost no point to even having it because the end result was the payments were too high. So luckily, as the years have gone on, as things have evolved, and there's all sorts of data about foreclosure rates, late payments, short sales, all that kind of stuff, the PMI payments now are super, super cheap and affordable. So, here in Chicagoland with prices, if you want to buy a $500,000 condo in the city, you need $100,000 cash liquid for the 20% down payment. That's a lot of money, especially if you're, a first-time home buyer, even your second home purchase. It just takes a lot of time to naturally accrue that much cash, especially with taxes. You probably have to earn, maybe 130 on your payroll to then actually take home 100 grand of liquid cash. So because of how rare that is, when I have buyers that have 20% down or more in the city, it is almost always a gift from family, which is awesome, right? The parents kicked in some money. Maybe it's a married couple, and so you have parents over here, parents over there, whatever the source. But almost always when I see 20% down in the city, it's very commonly a gift from family. So with absent of that, because not all families have the ability to give that much dough. Very commonly, 5% down, 10% down options are super doable. And, for example, you might have someone get a $400,000 condo with, 5% down. So that's $20,000, which is still a lot of money. but your PMI, which is what you're paying monthly, it might be $100. It might be, $100 and some dollars. And if you picture a teeter-totter like at the playground, you have $100 a month here, and then you have $60,000 over here, So it's become so much more affordable to help people with lower down payments still be able to get into a place without that 20% benchmark.
Awesome. I think it's just a misconception. Like everyone asks me like, well, I don't have 20% down, I can't buy a house. So it's good to hear kind of like the numbers of really what that PMI costs, just because I think a lot of people are afraid of it or think it doesn't make sense.
Yeah.
So
yeah,
yeah, go ahead.
No, please.
No, I was going to say, so, once you get the pre-approval in place, you're basically ready to go out and shop. So Michael's going to give you, say, a pre-approval for $500,000. And then from there, we get to do the fun part. So you get to get him all the documents and get him everything he asked for. And then we get to get shopping. So basically the process, we get to do the fun part. So we'll use the MLS and other. Everyone's got a zillion apps on their phone when they're looking for real estate. So we'll use a combination of the MLS and whatever app you're using. And we'll basically try to narrow down everything out there that fits, plus or minus 10% of what you want to spend on a property. And we'll look at all those online. So we're going to really screen those hard and use all the online information as a first time, the first showing. So the first email you're going to get from me is probably going to have 100, 150 properties. So it's going to be a little overwhelming. But the following emails, you'll get a trickle of 5 to 10. And so we're really looking for those top 10 properties, right? So once we have 5 to 10 properties as your top group, we're going to set up a day, preferably on a Friday if possible. It's just easier to navigate the city, and we avoid the rush of the weekend as far as people getting out and shopping. So we're going to go see back to back all of the properties. So maybe 5, maybe 10. It depends on how much you bring that list down. And the reason we're going to do that is because the worst case scenario is we go see 3 on a Saturday, and then we go 3 on the following Saturday and 3 on the following Saturday. And one, it's hard to benchmark those properties against each other unless you're seeing them back to back, right? So if we see them back to back, we're looking for a top 3 list. The other worst case scenario is on the third weekend, you realize, hey, that one we saw on the first weekend, I love that. That's the house I want to buy. And guess what? It's under contract. So now the rest of your search, you're gonna be benchmarking everything against that, saying, oh, I like this one, but you know what? It doesn't have the kitchen I really want, or I don't like that there's no bathroom on the main level or whatever. So if we do it this way for the initial group of showings, inevitably there's 1 or 2 properties that stands out against the rest. And since we've looked at everything in your range of possibilities, you will be in a good position to feel like that you have enough information if you find that property you love. So and the other reason we go out on a Friday is because everyone's hosting open houses on weekends. Maybe not right now, but in general, everyone's hosting open houses on the weekends. So you kind of beat that rush, and because the last thing you want to do is get in a multiple offer situation. So if we go out on a Friday, we beat that rush. And if you find the property you like, we're not competing with a bunch of people that are going through there on Saturday or Sunday. So once we find it, from there, I'm going to pull together like a full analysis of the property for you. So we're going to look at a couple things. We're going to look at comps. We're going to look at price per square foot. And then we're also going to look at how much inventory is in the market. And then using these 3, we can start to triangulate a price, because real estate's kind of like snowflakes, right? Each one is unique, right? Even if you're in the same condo building with the same layout, you may be a couple floors higher, a couple floors lower, different finishes. So we're going to use all that to benchmark. And then I'm going to give you a price that says, hey, if I were you, I wouldn't pay more than X for this property, right? And then we're going to look at inventory levels to say, hey, look, there's 7 other properties available in that building. You could probably be pretty aggressive with your offer, and we might be able to buy this below market. So once we do the search, we're going to do the analysis, and then we're going to write up the offer and hopefully, get it accepted, right, with a little bit of negotiation. So once we have the signed offer, that's when we get Michael back involved after the pre-approval, and then he goes through the formal underwriting process. So why don't you tell us a little bit about, once we have the contract, what that looks like?
Yeah, absolutely. So basically, I joke with all of my clients here that once you go under contract, we're going to become besties for the next 30 days, 45 days. we're going to be talking often. We're going to be, having some emails go back and forth. What we try to do is keep everything as electronic and digital as possible, right? Especially during these crazy times here. We're not meeting at a Starbucks and getting your W-2s, right? Like that day is no longer here. So basically, we will have already done upfront work on making sure that your credit, your income, and your assets are all lined up to allow you to then close on the place you want to buy. Then as we go, there's this big kind of dump of data from you to us. It's typically, a W-2 or two from the past 2 years, a couple pay stubs, a couple bank statements where the down payment funds are coming from, photo ID, just very basic things. So we get all that from you. We get all your loan documents put together. You'll e-sign a bunch of stuff. It's gonna, seem like 100 pages of numbers and whatever state and federal disclosures you got. You kind of just click through it. But once we get your initial loan package signed by you that has a general framework of the loan and the financing that we've already discussed. So by now we've already discussed what kind of term you want, what kind of interest rates appropriate for your situation, as far as your monthly payments, down payment amount, are you going to have your taxes included in your payment in an escrow account? All these different factors that go into it. So after we have all the ingredients of your financing put together and then the documentation to support it, we pass that off to the underwriter. Once the underwriters get it, he or she will really dig into it. Underwriters, sometimes I feel like they're from another planet with how they dive into things and how they think. That's good, right? That's good for their job. So they'll dig into everything with a fine-tooth comb, and then reach back out to myself and say, hey, Michael, your clients Jane and John Doe, they're good to go. But if you could please ask them for a better copy of this statement that came over fuzzy, or I'm missing 2 pages of this retirement account, or hey, there's a house that I think they owned before. Have they sold it? Just basic questions, basic little knick-knack things to help kind of complete the puzzle. And usually there's 1 or 2 back and forths, right? We give everything to underwriting. They then request a couple things from us. And then also they're requesting from the seller's attorney, the title company, the agents, and so on. Once we put all that together, get it back to them, they review it. We check all the boxes from what they needed, and then they will issue our clear to close. 3 of my favorite words. Tom, I know those are some of your favorite words too. And then we're around in third base. We're almost at the finish line. So get the clear to close, update all the parties, let the attorneys know, because they're going to help schedule the actual closing, the date, the time, location, and all that. Let the realtors know so that the buyer's agent, Tom, you can let your buyers know we're good. The seller's agent can let their sellers know they're good because they might be selling and moving on to their next property. So update everybody. After that, get the loan documents to the title company. Historically, I would be at the closing. Tom, you and I would, show up a little bit early and make sure all the paperwork is organized and ready for the buyers. These days, that's unfortunately not the case anymore. They've actually, title companies are restricting pretty heavily who can actually be in the room. So I know lenders are not allowed anymore. I don't think realtors are either. A lot of attorneys are doing everything virtually on Zoom calls, or they're FaceTime with their phones or whatever. So it's a little different now, but typically, the closing date, you will either have gotten a cashier's check for your closing, down payment funds, or maybe a wire if it's a certain amount. So all the money's ready. We will have gone over numbers and figures well in advance, so that when you show up at the closing and actually put pen to paper, there's no surprises. It's just what we spoke about. You sign the papers, you get the keys, place is yours.
Yep. And while you're going through that with Michael, after we get the contract, so he starts running with the loan, we've got a few steps left to do. So within a week after, within 5 days, typically after you go under contract, you're going to do a full home inspection. So the guys are going to come in, they're going to spend 2 or 3 hours, probably, maybe a little bit less if it's a condo. And they're going to go through with a fine-tooth comb and basically find everything that's wrong with the property. So they're paid literally to find what's wrong with it. So expect them to find a few things. So you will get probably a 20 or 30 page detail report. Now, it's really important that you're at the inspection, because if you just read that report, nobody would buy a home, because it is a little bit daunting because of everything they find. And it's hard to know, if you haven't owned a home before, what's a big deal and what's not a big deal. So I highly recommend my clients, unless they're seasoned home buyers, that they come to the inspection. So once we have the report, what do we do with it? Well, we take it to the attorney, and between you, me, and the attorney, we go through it and we figure out like what are the 3 or 4 big items on there that we either want the seller to repair or we want to ask for a credit for. So we have a whole nother round of negotiations. So depending on what we find, we go back. Most of the time, I suggest you just get a credit because you want to make sure the work is done correctly and the seller just wants to get it done as cheap as possible. So I normally recommend you just get a credit. We try to push that as hard as we can to get you as much money as possible because I like to negotiate like it's my money. And if I can get you another $500, I'm going to get you another $500. So, so once we have that wrapped up, then you will post the remainder of your earnest money. So once we agree on whatever the credits are going to be, you're going to post the remainder of your earnest money. Sorry, my kids knew it was inevitable. You're going to post the remainder of your earnest money. And then at that point, you are locked into buying the house. So up until attorney review, you can basically back out for any reason. Once you pass attorney review, the only reason you have to back out of the house if for some reason one of your documents was wrong, or you lose your job, or you go buy a car in between.
Don't do that. No cars. Don't do it. Don't do it.
Or you go buy like a car or something, and Michael has to give you the call. Hey, you're not going to be able to get this loan. So that's your only out at that point. So those are the things we go through. And then once Michael gives you the clear to close, we'll schedule the final walkthrough. So we're looking for big items, damage when people moved out, maybe a storm, water damage, etc. Make sure the house is in the condition you expect it to be in. And we normally do that either the morning of close or the day before. And then we're off to the closing table to sign all the paperwork and get you the keys. So that's kind of the process in a nutshell. From start to finish. It can take anywhere from 40 days from when we first engage, if you're super fast and we find the perfect home, to a couple of months, depending on what the inventory looks like. So it really ranges. It depends, but I think if we the most successful clients I've had when we've worked through this process tend to find a home on their first or second time out, just because we've done so much homework on the front end.
Yeah, no, absolutely. As much preparation as you can do with your clients, as far as the properties, everybody has their needs to have and their nice to haves, right? And you obviously want to make sure how you prioritize things, and I know personally as a homeowner, my wife and I, when we moved up to the suburbs from the city, we're like in our heads, we're like, okay, we have to have these categories and we do not want that. Then you actually go and see the house in real life and you're like, yeah, you know what, that's not that big of a deal, right? That's not going to be a deal breaker. Or, wow, this is way more important than I thought. It's rising up the list, So as long as you're managing the expectations of the buyers from the property perspective, I obviously want to make sure that I'm managing their expectations from a payment perspective. So there's no surprises. We know that the monthly payment all in, the mortgage, the property taxes, the homeowner's insurance, if there's a condo, there's HOAs monthly. We want to make sure that fits in their budget, because this is not a short-term purchase, right? This ain't Amazon Prime. You can't return it if you don't like it, tomorrow. This is a long-term investment. So we want to make sure that the payments are sustainable, they're comfortable. You're not house poor or anything like that. And one other thing I was going to touch back on, if you don't mind.
Yeah.
While I was taking a couple notes here, but I was also jotting down a very simple kind of little math equation here. That I do for all my clients, and I've heard over the years it's just very helpful in helping them filter out what price points of properties they should be looking at, which obviously helps you in your search to take it from 100 properties down to like the top 3. So very easily, people can figure out online with calculators or whatever resource they have of what the most they're approved for, right? I get asked that every day. Michael, what's the max? What's the limit? What's the ceiling of what I can buy? That's very simple math. But just because you can afford, an $800,000 house doesn't mean you want to pay $7,000 a month, right? Very commonly people can afford a place here, but they want their monthly payments to be closer to here, right? So what I figured out over the years is, instead of starting from a place of the maximum someone's approved for, and then they go out searching and whatnot, I start from a place now of how much do you want to pay monthly, right? So I would ask the clients, if you could come up with a number right now that, we're not going to hold you to it, but if you had a number in your head that is comfortable, it's long-term, it's sustainable, and it would encompass everything. So mortgage, tax, insurance, assessments, everything about you buying this property, what does that number look like, right? So I did a very, I'm going to see if this even shows up here. I did a very simple kind of, and sorry, my handwriting's horrible here, but very simple math equation, right? $2,500 a month is a very common, rent payment and mortgage payment, especially for a first-time home buyer. So what I'll do is I'll take the $2,500 monthly payment that they want. I will subtract out a few categories that we know are going to be part of the equation, right? So here, I just kind of put $400 for taxes a month. So this is all monthly. So $400 in taxes a month, that's $4,800 a year. We have HOAs, on a walk-up maybe, $250 a month. Insurance, it's like it's like renter's insurance. It's like $400 or $500 a year, very cheap. And then I put in kind of a basic amount for PMI. You don't have 20%, right? So I take the number they want to pay. I subtract out what we know is going to be part of it, and I'm left with this number down here. Then, with my super fancy mortgage calculator that no normal human being would ever want or need, I'm able to then put this number into the calculator and solve for how much money you can borrow, right? What the loan would be. And I use a couple round numbers here. So when I do that, that gives me a number of $400,000, right? So very often I used to do this in person, but if I'm doing it over the phone, I'll come up with 400 grand. And the person might be, I can tell sometimes they're a little disappointed because they were thinking of a higher price point. And I go, but wait, there's more. I go, that's just the loan. That's before your down payment. So if you had a 5% down payment, then you could find a place for 420, put 5% down, and then get to your payment. If you have 10% down, you could find a place for 445, or if you have 20%, you can go up to 500. So then I basically would tell the person, hey, if this is the payment you want, and you feel that you could find a place in these price points or have these dollar amounts for down payments, then we're ready to rock.
That's huge. I mean, that's very helpful. I think, people forget about those other expenses. So it's good to pull those out, and it's good to start from a place of like, what do you want to pay per month? Right. Because the rates are just so low right now that, it goes a long way. So, well, good. Anything else you wanted to cover before we wrap this up?
Yeah, I'm gonna do one more basic math equation here. I'm not even gonna use my my horrible writing. I'll use my fancy calculator if you can see this here. So basically, when in the city, there's a lot of condo buyers, right? And the assessments can vary, 250, 350, 750, 850 if you're looking at high rises, places with elevators, doormen, all these amenities or whatnot. And that has a lot of value, in the assessments if you need it. Like if you need a doorman, if you need an elevator, if you need security cameras, I totally get that. But then you're paying for it, right? And not everybody needs all of those amenities. So what I always share with people when they're looking for condo purchases specifically is the weight or what the condo assessments would equal, or if they were converted to financing, what that equation looks like. It always blows people's minds. Excuse me, always blows people's minds here. So basically, when you're borrowing money on a mortgage here, especially just a 30-year conventional mortgage, we're stretching the money out over 3 decades, right? That's 360 months that we're stretching out this money. So when you add, I have people, I'll run numbers for them on a payment for a $400,000 place. And then they'll call me back and say, hey, Michael, we might go to 405. What's the payment? And I'm like, it's like $20 more. It's like peanuts, adding 1,000, 5,000, 10,000 to hundreds of thousands over decades. It's like throwing a bucket of water in Lake Michigan. You know what I mean? Like it's nothing. Like you don't even notice it. But the assessments have a much more of an impact, because those, instead of being stretched out over 360 months, assessments are stretched out over 1 month, right? So the quick, easy kind of, the rule of thumb when it comes to assessments versus how much you can borrow on your financing, for every $100 of condo assessments a property might have, if you took that $100 away from the assessments and put it towards the condo, you could finance over $20,000 more dollars of property, right? So, when people, will send me different condos, and you might see assessments of like 300 and then like 450 or 500. You don't think that's that big of a delta, right? 300, 500, yeah, it's $200. What is that? What's the big deal? But if you chose the less expensive HOAs, that's 40 grand more condo you can get. And you know what, 40 grand, that's another bedroom, that's an updated kitchen, that's garage parking, that's all sorts of things that to me personally have way much more value as opposed to, just sending that to the assessment. So I always let people know, clearly you can tell I'm not a fan of like the high-rise places, but I always want to share that with condo buyers specifically that, I know the assessments, a lot of people think it's kind of a small piece of the puzzle of financing, but every $100, if you put a, 20,000, 240,000, it starts really adding up and you just get way more bang for your buck on the property instead of the assessments.
Yeah, that's great. That's great math to kind of have in your back pocket. So, well, thanks everybody for joining tonight. I hope you guys found this helpful. We will send out a link to this afterwards in case anyone wants to see our pretty faces again over Zoom. I mean, we're all sick of Zoom at this point. So everybody have a good night. Thanks for joining, and give us a call. I will follow up with our information too. So when you're ready to make a move, you give us a call. Thanks again.
Thank you guys. Have a good night. Take care. Be safe. Bye.
Bye.